The year is 2000. Brussels gleams. A room full of economists studies their charts and the line climbs steadily upward. Productivity, investment. Growth arriving on schedule, like a train that never runs late. The math says it will keep climbing forever, right? Wrong. 30 years later, that exact line flatlines. It never climbs again. You want to know how a continent loses its economic pulse? It starts with a number nobody calculates early enough. It ends with a system that got structurally expensive, and the trap was set in plain sight, in that room, at that chart, by economists who believed the rules would never change. But the rules were already breaking. From 2000 to 2019, the United States grew labour productivity at roughly 1.8% each year. Europe managed 0.8%. That's less than half the pace, and your paycheck feels the difference before any economist notices it in the data. Not evenly distributed, not a temporary lag. Over 2 decades, that small gap compounds into a continental chasm. American workers added 44% to their productive capacity. Europeans added just 20%. Thousands of factories, millions of workers, and the physics of output per person tilts inexorably toward one side of the Atlantic, putting capital, talent, and investment with it. But here's what most people don't see coming. But there's a deeper number that explains everything. Total factor productivity. This measures how much extra output you squeeze from the same machines, people, and inputs. In 1965, the United States produced 3% more output per dollar of input each year, and Western Europe matched that rhythm without breaking a sweat. That rate is now 0.5% in both places. But here's what happened to Europe specifically, the moment that changed everything. In 2008, when the financial crisis hit, total factor productivity plummeted across the continent, with Germany losing 5 to 10% in months, and France, the Netherlands, collapsing with it in ways they've never fully recovered from. The damage was permanent. The recovery never came. Now you might think Europe solved this by investing more money into the system. The data suggests something darker. In 2022, the European Union invested 19.3% of its GDP in capital and new ventures, while the United States invested 17.5%. So Europe was putting more money in, yet somehow it was going to the wrong places. Listen carefully to this number. The EU operates 35 different stock exchanges across 31 countries, clearing through 17 different central counterparties, settling through 28 different depositories. The United States has 2 listing exchanges, 1 clearinghouse, 1 settlement system. Not more freedom, more fragmentation. When capital is fragmented that deeply, it doesn't concentrate power, it diffuses it. Efficiency drains away before your investment reaches the factory floor, and that's the structure nobody wants to admit they've built. Between 2020 and 2025, the United States invested venture capital equal to 0.7% of its annual GDP, while Europe managed 0.3%. That 0.4 percentage point difference doesn't sound catastrophic until you understand what it funds. A single venture round backs 1 company to scale into 10 competitors, and 10 becomes tomorrow's industry, which means you're not just delaying innovation, you're watching your brightest people board planes to Silicon Valley instead of building in Berlin. The proportion of European venture-backed IPOs that happen in the United States has tripled since 2015 to 22% by value now, which means the capital leaves, the jobs follow, and the next generation of European companies gets built somewhere else. When the smartest people leave, they never come back. Now comes the structural wedge that nobody escapes, the one written into every factory's cost sheet: energy. In 2024, industrial electricity in the European Union cost €0.199 per kilowatt hour, while in the United States it costs €0.075 per kilowatt hour, which means Europe's electric bill was 2.5 times higher for the exact same machine doing the exact same work in the exact same output. Where does that chasm come from? Natural gas prices. The United States produces vast quantities of domestic shale gas and can power factories cheaply, but Europe produces almost none of its own gas and must import it, paying 3 to 5 times more per unit than Americans do. That difference sits in every factory's cost structure, like a permanent tax on competitiveness, that will outlast every government now in power. And that's just the beginning. What happens to a factory when its input costs are locked in at a permanent disadvantage relative to its global competitors? It makes less. It invests less. Eventually, it closes. The European Union's industrial production grew at an average rate of just 0.6% per year from 2000 to 2024, which is almost flat. And country by country, the picture gets darker. Ireland managed 5.6% per year, Poland 4.9%, but Germany, France, Italy, Austria, the oldest industrial heartland of Europe, stagnated or contracted outright. In 2023 alone, industrial production in the Eurozone fell 0.9%, the steepest drop since 2009, while American manufacturing was recapturing volume that had left the country 15 years earlier. Not because American factories got smarter, because American factories got cheaper. Your factory can't compete if your electricity bill is 2.5 times higher. And nobody's paid 2.5 times higher by accident. There's another layer that multiplies the damage, sitting on top of energy costs like a second tax. Regulation. Not all regulation kills growth, but when you stack energy costs on top of capital fragmentation, on top of productivity drift, then regulation becomes friction that only the richest firms can afford to absorb and navigate. A German industrial company must navigate European environmental standards, labour codes, tax rules in 15 different jurisdictions simultaneously, while an American firm navigates one federal system with clearer rules. The costs compound, the timeline stretches, the risk builds. So what does a smart manager do? She doesn't build the new factory in Germany. She builds it in North Carolina, where energy is cheaper, capital is available, and the rulebook is thinner. Your job doesn't move to avoid taxes. It moves because the arithmetic says survival happens somewhere else. The money doesn't invest in growth at home. It invests in escape. Not ideology. Not choice. Pure arithmetic. Here's what nobody says out loud in Brussels or Berlin. If productivity per worker grows at 0.8% per year, then wages can't grow at 3% per year. Not forever. The math doesn't work. Over 2 decades, American workers raised their wages faster because American productivity rose faster, and the growth math had permission to work. European workers faced a harder equation. Productivity stalled, inflation arrived anyway, central banks tightened, and real wages compressed like a spring that never extends again. Your paycheck feels the weight of this daily. The average American could feel their income keeping pace with inflation. The average European watched their purchasing power shrivel in slow motion. And that's the thing about growth constraints. They don't just affect balance sheets and quarterly reports. They affect the family dinner table. Once you've lost purchasing power, the only way to get it back is growth. But growth is what you don't have. When you rank countries by competitiveness metrics now, Europe's position relative to the United States has deteriorated in almost every category. Not because Europe got worse at the things it was already good at, not because your workers got lazier or less skilled. Europe became a place where the terrain itself shifted, and the physics of growth became harder than they were before. High energy costs penalise manufacturing. Fragmented capital markets privilege big firms with deep pockets. Productivity drift makes wages harder to raise without killing jobs. 1 year of headwind you survive. 5 years you adapt. 20 years of this, and it's not a trend. It's your structural position. It's not degradation, it's permanent disadvantage. And once you're there, getting out requires the one thing you don't have. Growth. Now comes the consequence that everyone can see, but nobody wants to admit. When economic growth stalls, politics radicalize. When wages stagnate, people vote for change. Not because they're irrational or ignorant, because the system they were promised isn't delivering what it promised to them. In every European country, far-right and far-left movements have gained ground in the last decade, not in boom times when opportunity is expanding and your paycheck is climbing, but in the slow growth years when the local factory closed and never reopened. You don't need to understand a mechanism to feel its effects on your life and your future. Right now, tens of millions of Europeans feel like the future was cancelled by someone else's decision. The mechanism was energy and fragmentation and regulatory drag. The result is political, not complicated, just inevitable. And the momentum is building. And here's where the trap becomes a cage that nobody can escape from easily. Once competitiveness drops, governments respond with subsidies to keep factories operating and jobs protected. Industrial policy, green energy subsidies, regional development funds. These aren't solutions, they're band-aids on a structural problem that subsidies can't fix. You can't subsidize your way out of higher energy costs permanently, not for 27 countries simultaneously, not for 20 years running without running out of money. At some point, the subsidies start competing with each other across borders, with countries fighting over the same investment, using public money as the weapon. It's a race to the bottom that consumes the entire budget. Meanwhile, the core problem hasn't moved 1 inch. Productivity stagnation, energy costs locked in, fragmented capital. The system is too expensive to improve, and your government knows this. But the alternative is admitting it to voters. So here's the question the IMF won't ask, and the European Commission can't answer, because the answer terrifies them. What if growth doesn't come back? What if the assumption that growth is cyclical and will return automatically is simply false? What if it's structural and permanent? Then every policy assumption built on a recovery that never arrives becomes a lie. Pension systems calculated on 2% growth indefinitely, healthcare systems budgeted for 3% growth, labour markets priced for 2.5% growth. Your retirement depends on numbers that won't materialise. But if actual growth is 0.6% and staying there permanently, then something has to give. Either growth comes back, or the entire promise of the European welfare state gets renegotiated downward. Those are the only options available to you. There is no third door. The question is no longer if, it's when. What does permanent slow growth look like in the street, in the neighbourhood, in the life you're actually living? It looks like a family in a northern city, working full-time jobs and unable to afford a house. It looks like pensions that promise dignity and deliver austerity instead. It looks like children leaving the country because the labour market can't absorb them or offer a future. Your neighbour is working just as hard as an American neighbour in a comparable job, same skills, same hours, same dedication. But the American is saving money, while the European is borrowing. That's what a 1% productivity gap does when it compounds over 2 decades. It doesn't just affect GDP numbers on a spreadsheet. It affects whether a middle-class person can still imagine a middle-class future. And once the future disappears, what replaces it is rage. The final consequence is the one that echoes through generations and doesn't announce itself loudly. Smart people leave places that don't grow, not because they're selfish or disloyal, because they're rational and reading the same math you are. A software engineer in Stockholm with an offer from Silicon Valley sees the numbers clearly. Venture capital density, the network of scaled companies hiring, access to growth capital, versus a fragmented capital market and venture funding at 0.3% of GDP. That's not a complicated choice. And every engineer who leaves is one fewer person generating new companies, new ideas, new growth at home. Europe isn't failing because people got dumber or lazier. It's failing because the system got too expensive for talented people to stay and build. Hollowing out doesn't announce itself with fanfare, it just happens quietly until the room is empty. And once it's empty, filling it again takes more than money. Back in that room in Brussels, the economists are still drawing their charts, still planning for recovery, still calculating how much stimulus would be needed to trigger the multiplier effect, and when normal returns. But the line doesn't move. It never does when you're standing at the wrong place on the map. The system isn't broken, it's just expensive. Permanently expensive. And in an expensive system, growth doesn't come back automatically. It comes back when energy prices shift, when capital markets consolidate, when productivity mechanisms rewire. Until then, the line stays flat. Everyone inside it waits for tomorrow. But tomorrow was already written in the structural costs you locked in 20 years ago, in that room, watching that chart climb, believing the rules would never change.